Turn to the market impact now of these tensions, because my next guest does see some increasing inflation and volatility, but says they're just one of the risks that could have prices climbing again. Dan Suzuki is here now. He's Deputy CIO at Bernstein Advisors. Dan, just quick response before I just kind of get your broader thoughts on the markets here.
Yeah, I think, listen, we're not geopolitically focused firm, but I mean, anytime you have geopolitics flare up, I mean, there's two immediate impacts for the markets. One of them is inflationary, potential risks to supply chains and commodity supplies. And then also, obviously, what we're seeing is market volatility on the back of it. So I think the way to protect yourself from that is to own the beneficiaries of that inflation or that volatility. I think one way is to own commodities or commodity producers here, which give you protection against the geopolitical as well as potentially the longer term secular theme of deglobalization, Kelly.
Well, now you have kind of the easier trade as well of China. How much do you buy into Chinese beneficiaries on the back of all these policy measures they continue to announce?
Yeah, obviously, as far as the trade goes, I mean, the trade has been working out well, and the trade is reflecting sort of this moment where, policymakers in China are starting to panic. And as some of my old colleagues have mentioned in the past, markets stop panicking when policymakers start panicking. So I think it remains to be seen whether this is going to have follow through or it's going to be one in a string of, moments where the market thought, this is the beginning of a bazooka here. So I think that we have to wait. And ultimately, for us, it's about whether that stimulus is going to turn into growth and ultimately turn into profits. Now, I think the difficult thing for China is that we think that China, which is their profits have been accelerating for now 8 quarters, is probably closer to the end of its profit cycle unless you get a major move of stimulus than it is to the beginning of its profit cycle.
That's an interesting cautionary point. And I love that line as well about panicking. More broadly, we're going to hear from Powell a little bit later this hour. We just heard from Bostic indicating some openness to a half-point cut if labor weakens, and we're going to get the big jobs report on Friday. How are you guys thinking through this?
Yeah, I don't, ultimately, I don't think it's really going to be a matter of, how much the Fed cuts at the next meeting or the meeting after that. I mean, when you step back from the bigger picture over the next 6 months, the market has, call it 150 basis points of further easing. I think that's a tall order, given that I'm not as bearish on both the inflation or the growth outlook here. I think ultimately you'll see probably inflation come in higher than what's priced into the market and growth come in a little bit better. I don't think it's collapsing. I don't think we're in the midst of a huge growth spurt, but I just don't think it's slowing as fast as the market seems to be pricing in here.
Real quickly, Dan, then I'll mention this headline from Austin Goolsbee in just the past few minutes, where he says rates have to come down a lot over the next year. What you're saying and what a lot of people see happening with the economy and what the bond market is pricing in seem to be at odds with the bond market is on Goolsbee's side saying rates are coming way down. A lot of others are looking around and going, I don't see how.
Yeah, I think it's tough. I mean, I think if you look in a world where Fed is the only source of liquidity, then you're looking at a world that's very tight, and you could argue that the Fed does have a lot of easing to do. But when you step back from it, you look at financial conditions, you actually see that the liquidity is actually quite rampant and abundant. And so I don't think you need the level of easing that Goolsbee is talking about. And in fact, if you start a massive easing policy here with inflation at 2.5–3%, that's going to, into a tight economy, that puts a lot more upside pressure to inflation at a time when we have geopolitical concerns and potentially tariffs and potentially China starting to stimulate. These are things that you have to consider that might put that sort of easing outlook at risk.
Oh, and you're sticking with the small caps, the deep cyclicals, other emerging markets as well, looking for commodities and inflation trades to benefit in this panorama. Dan, for now, thanks. We appreciate your time today.